Hope everyone had a little delightful lunch. Sort of following up on the theme of funds that might not have enough funding in them, we're gonna talk about the transportation fund right now. Thank you, Chris, for taking us through one of these little corners.
Sure, my pleasure. For the record, Chris Rupp, I'm a senior fiscal analyst at the Joint Fiscal Office. It's nice to see many of you that I've worked with in prior sessions, and to those I haven't, welcome, congratulations. Thanks for being here. Looking forward to working with you. The hard copy, I'm just going to work off a hard copy because I was told the committee's preference is to do that. So I'll try to call out page numbers as we go, so anybody following along at home can keep track of where we are. But on the second slide, just gives you a real quick sense of what I'm hoping to cover today. I'd like to give you all a sense of how Vermont pays for transportation. Where does that state money come from? Where does it go? How do federal funds come into that equation? And some considerations for you all as legislators. So slide 3 gives you sort of a high-level overview of the as-passed appropriations in the last few years. And you can see that federal funding is the largest component of our transportation program. It's slightly over a majority of the dollars that go into the transportation program. We are not unique in that matter. Really, every state uses a mix of state, local, and federal funds. But we are a little more reliant on federal funds than a lot of other states are because we're such a small state. One of the things that, we're very blessed to have a lot of federal funding at our disposal, and a lot of it does come through formula. So we have a good sense of what we're going to get from year to year. And there's a lot of flexibility in how to use those dollars. But those dollars are not free. They all typically require a non-federal match to draw down. So the infrastructure bill that just passed presents a great opportunity, but also a great challenge, because Vermont is scheduled to get a lot more money, but it is going to require more non-federal dollars to draw it down. When we talk in the transportation space, every federal program has its own rules, but a good rule of thumb is an 80-20 match requirement is standard, where if you've got a $10 million project that's federally eligible, the feds would pay, $8 million of it, and the other 2 would be up to the state or other non-federal sources to pay. But something that's really important to keep in mind is not everything that VTrans does is eligible for federal money. A lot of the core road and bridge and public transit is, which is great, but things like operating the DMV and maintaining our road system, so plowing, salting, doing sort of minor maintenance type work, that's all not federally eligible typically. So you'll see state T-fund dollars paying those costs. There's sort of a theme in the transportation space that goes back decades, where most places fund transportation on what's sort of a user-paid model. And, most of the money that we bring in comes from motorists and people who are operating vehicles. They'll pay things like gas taxes, registration fees, so on and so forth. We don't capture revenue from everyone who benefits from the highway system. It's really the users who pay. It will come as no surprise that we have a transportation fund in our state that has dedicated revenue sources that go into it. And that transportation fund is the primary source of supporting VTrans's budget. There are a few other areas where you'll see T-fund dollars in the budget. Some of it will go to support this, typically goes to support the state police, about $20 million a year, about $4 million a year, supports the operations of the information centers along the highways. So, the custodial work, the operations of keeping them going is funded out of a T-fund appropriation to BGS. And you'll see a few other transfers here and there. But generally, the transportation fund, the vast majority of the dollars go to support VTrans. There's also a second smaller fund within the T fund called the TIB fund. It's called TIB, stands for Transportation Infrastructure Bond Fund. About 15 years ago, the TIB fund was set up as a mechanism of paying for revenue bonds that the state could issue to support transportation capital projects, with a long useful life of at least 30 years. The state had previously issued 3 rounds of TIB bonds. Last year's BAA, and they totaled about $36 million. Last year's BAA fully paid off the outstanding TIB bond balance. So the decks have been cleared in terms of ongoing debt service commitments. And the state does have the financial ability to then go out into the market if they want to and issue other rounds of TIB bonds. And they have a revenue stream to sort of pay that debt service. The TIB fund has a dedicated assessment on gas and diesel. So generally the way the system works is if you have bonds outstanding, the debt service obligations are satisfied first. Whatever residual money is left over in the TIB fund can then be spent on a pay-as-you-go basis. So you'll see TIB funds throughout the agency's transportation program as well. Something that's really interesting about Vermont, and I think we should get more credit than we do, is Vermont, unlike a lot of other states, really funds almost all of its transportation program on a pay-as-you-go basis. So we really are not very reliant on issuing long-term debt to pay for projects. Aside from those rounds of TIB bonds that were issued, about a decade ago, and a lot of that went to doing interstate bridge work and Champlain Bridge, things like that. We typically don't do a lot of borrowing in the transportation space. Slide 4 is where the sort of not so great news starts to trickle in. I put a chart here that shows the actual revenues as well as the two most recent revenue forecasts for the T fund as well as for the TIB fund. You'll see here, and we're going to go through these in a little bit more detail, but this just gives you a sense of how much money comes in from various revenue sources. You'll see at the top, gasoline taxes and assessments for FY23 are going to bring in just over $74 million. But compare the forecast in the future years to where our actuals were in prior years. Gasoline is a declining revenue source. It really peaked in about 2005 and has been slowly declining ever since. And the latest forecast that was approved by the emergency board earlier this month assumes an actual negative compound annual growth rate in the next 5 years. So we expect gas tax receipts to continue to decline over time. We also bring in money from diesel taxes. It's a pretty constant stream of money that doesn't fluctuate a lot from year to year, but it's not a huge proportion of the program. Purchase and use tax has been a growing source of revenue, and that has actually been upgraded in the latest revenue forecast. DMV fees are projected to be relatively flat. DMV fees are set by the legislature through fee bills. We haven't had a fee bill since 2017, so in this space, so that's why you don't see a lot of projected growth there. And then there's another bucket of miscellaneous revenue, which is a lot of really small items. So the revenue you get from overweight permits, vehicle inspection stickers, the oversized truck permits, the civil traffic fines, railroad income, jet fuel sales tax, all these really little things go into the miscellaneous revenue category. You'll see the TIB fund down below. Gasoline assessments, they have their own dedicated gas assessment based on 2% of the average retail price of gas. And there's 3 cents a gallon for diesel that go into the TIB fund as well. I like to add them both up to see what the total pot of money that will be available to support the transportation space will be. And you could see that at the very, very bottom that this latest revenue forecast actually downgraded the combined funds by 2.8 million this year. Over the next 5 years, from FY23 through 28, the all in transportation revenues are expected to grow by 1.13% on average annually. Do we think costs in this environment are going to increase by 1.13% a year? I think it's probably unlikely. Slide 5 just walks through with some pictures of how much each revenue source contributes to the total pot of funding and how they've changed over time. You can see that the bottom blue segments of the columns represent your gasoline revenues to the T fund, and they've been declining over time. But you also see that gray bar in the middle, the purchase and use tax, has been going up quite a bit. The pandemic has had sort of an interesting impact on the T fund where the fact that folks really haven't been driving as much, there's been a lot more working from home. All the travel restrictions earlier in the pandemic really put a dent in gasoline consumption. But on the other hand, vehicle sales have been going like gangbusters. So there's been a huge amount of stimulus money flowing through the economy that have led people to purchase new cars when they can get them. Inventory constraints have not only driven up the prices of new cars, but also used cars, because a lot of people who maybe didn't have a new car available then went to a used car instead. So you're seeing not only higher prices, but stronger demand driving up that purchase and use tax, which, as you all know, has also benefited the Ed Fund in the last few years as well. Slide 6. From now on, I'm just going to go a little bit into the details of each particular revenue source, but I'm going to try to keep us between the ditches and out of the weeds. We have what we call a hybrid gas tax system, where we have a flat component and a hybrid component. The flat fixed component doesn't vary with price. It's really fairly straightforward, and it totals 13.1 cents. So that includes the 1 cent petroleum cleanup fee and then 12.1 cents worth of taxes. You could see in the chart here that 11.345 cents of that 13.1 total remains in the T fund. Something that's really important to keep in mind with fuel taxes in general is that they're not levied at the retail point of sale. They're levied at the distributor level. So whenever a fuel dealer brings a big truck full of gas into Vermont to deliver to a Vermont retailer to sell in Vermont, that dealer is the one responsible for remitting the tax to DMV. That's another thing. All of these transportation taxes are collected by DMV, not by the tax department. Why do they do it this way? It's a lot easier to chase a few dozen fuel dealers for their payments when this is a core part of what they do as a business than it is to try to go after hundreds and hundreds of retailers. And this is a very common way this is set up. But this is significant when you start thinking about how a change to the taxes might change prices at the pump, because there's a huge lag built into all of this. So you're really taxing people upstream at the dealer level, and the price of the taxes is baked into the price somebody ultimately pays at the pump. So it's not like when I go out and buy a soda and there's, $1 or whatever, and they charge me $1.06. It works differently with gas taxes. The tax has already been paid at the time the truck dropped off the fuel at the retailer. Something else to keep in mind is we've got state gas taxes, but we also have a federal tax of 18.4 cents a gallon. That goes to the Federal Highway Trust Fund, which supports most of the transportation formula funds that come back to us from Washington. That 18.4 cent a gallon rate has been unchanged since 1993 when I was in kindergarten. So that is something to just keep in mind about the power of eroding purchasing ability over time. Slide 7, I talked about the fixed taxes. We also have two what we call assessments. The assessments are the variable components. One of them is a 4% assessment that goes to the T fund, and the other one is a 2% assessment to the TIB fund. They work mechanically very similarly, but there are some differences. The 4% is not a sort of conventional sales tax where it's not based on the retail transaction. It's based on a lag. So the way this works is all of these, the prices in the prior calendar quarter influence the rates to be charged in the next calendar quarter. So here's a little example here in the chart, because the math can get, when you're reading the words, you're like, huh? And then when you see the example, it makes a little more sense. But every quarter, the Department of Public Service surveys gas stations across Vermont to calculate an average retail price of regular gas. That average retail price for the quarter, they then subtract all of the state and federal taxes and fees that were collected during the prior quarter to reach a tax adjusted price. Then you apply 4% or 2% to that tax adjusted price, convert it to a cent per gallon equivalent, and then that is the rate that will be charged on fuel dealers for the upcoming quarter. There are minimums in statute for the two assessments where the 4% has a 13.4 cent a gallon minimum. What that really means is when average retail prices at the pump are below 3.87 a gallon, that 13.4 cent floor kicks in. There's also a maximum of 18 cents a gallon, which means when prices at the pump are over 5.08 a gallon, that 18% maximum kicks in. And if your prices are between 3.87 and 5.08, it's 4% of that tax adjusted price. So it floats between 13.4 and 18. The first time this happened in recent memory was earlier this fiscal year when gas prices went up above 3.87 a gallon and brought these assessments above their statutory minimums. And you'll see that happen in this chart here where it went from 13.4 up to 15.91. There's no maximum on the TIB assessment. There is a minimum of 3.96 cents a gallon, which kicks in when pump prices are at 2.48 or below.
Do you know why we do this in this particularly convoluted way?
You know, I
understand the minimum maximum part. I can see the rationale of that, the looking back, looking forward. Did you do it? Were you here when this happened?
I was here when we did the funds.
Yeah.
Right next door. Richie Westman was chair and I was there with Sue Minter. And the backstory is roads were falling apart and the governor didn't want to spend any money on this road to affordability, which is taking things out of the book so that they fell apart. At that time, if you don't mind, just a little anecdote.
Please.
You couldn't buy bottled beer in Norton, Vermont because the bottles would break on the trucks. So you could buy canned beer, but not bottled beer. So anyway, so Richie came up with this idea, gave him credit for it, which kind of evolved and came up as follows, which was that the long and short of it was that we would send a delegation to Wall Street and have them figure out what would be an appropriate amount to bond for. And that we would then pay for it as Chris is explaining here. And half of the money at that time went to infrastructure improvements and half went with, I guess they called it PAYGO. If I've got this right, it actually would go into the budget as you explained.
Exactly right.
So we already had the 4 cents, I guess, and then the 2 cents came out of this PAYGO infrastructure bond fund, which was really quite a nifty idea. And we were able to collectively persuade the governor that we should do this, and we've been doing it. And the high and the low came out of that as sort of a way of getting it through, right? We need this much money at least, but okay, we won't rip you off over a certain price. Yeah. Pardon my colloquial language, but anyway, but so that's where it came from. Still exists, must have been a good idea, so.
Yeah, and if I could just add
We
to,
should say that just because something still exists.
well, I will,
But this does sound like it works
Madam Chair,
up until this moment.
Madam Chair, you know, I typically try to avoid saying if something's a good or bad idea from the witness chair, but I would say the legislature exercised a degree of wisdom when they created this, because what this does is build a degree of revenue sensitivity into the equation. Think about everything V-Trans does. When gas prices and diesel prices are going up, it drives their costs up. This is a way of getting a little bit more revenue into the system when prices are trending particularly high and also leading to higher costs. You also sometimes have, when prices are really high, people might not be driving quite as much as they otherwise would. You know, conventionally, gasoline is viewed as highly inelastic to price in the short term. But that's starting to change a little bit more in this ability to work remotely. This, you know, we don't have the rigid work structures we had, 10 and 15 years ago. And when prices are really, really high over a long time, it does start to influence your behavioral decisions where it's like, I don't like paying $4, but I'm going to grumble about it in the near term. But when it comes time to buy a new car, maybe I'm not going to replace my F-350. Maybe I'm going to get something that's a little more fuel efficient. So I think the legislature had exercised some wisdom when they had built this sensitivity in.
And the other clever part of this was that since the the word from the executive was we're not gonna raise taxes. Instead, just set up a bonding function, paid for as pay-as-you-go kind of stuff like that through this assessment. And so it didn't start out quite so linear, I guess, but it
There were some changes made along the way.
came along to it. It's a good model. It's one that could be used in another place.
So slide 8, I'm not going to dwell on this, but this is just because we already kind of touched on it, but this just gives you a little picture of the trend of gasoline consumption over time. This is not a growing revenue source. It is declining. It has been declining. It really peaked in gasoline consumption peaked in Vermont right around 2005 or so. Not coincidentally, I remember that period of time pretty vividly because when Hurricane Katrina hit in 2005 was the last time I remember gas prices ever being less than $2 a gallon. It went up above that and never seemed to go down. But you can see that this trend of downward consumption started really before the prevalence of EVs. This had been something in the works just because conventionally powered vehicles had been getting a lot more fuel efficient over time. Prices have started to go up. That we didn't have decades and decades of relatively cheap gas. But you can see the little dip there that the pandemic caused on the far right graph, which was pretty disruptive. This trend is, I think obviously going to continue over time. The decrease is going to accelerate in future years as EVs and, more efficient vehicles gain market share. But I think realistically, gasoline is going to be sold for the foreseeable future. It's not going anywhere immediately, but we're going to be taxing and using less of it. That's just going to be the trend that's going to be happening. Slide 9 just touches on diesel real quick, which is not as exciting of a topic, but you can see that Vermonters pay a total of 32 cents in state taxes, 28 cents to the T fund, 3 cents to the TIB, 1 cent to the Petroleum Cleanup Fund. There is no price sensitivity built into this. These are all flat rates. There's an additional federal tax, so all in, Vermonters pay just over 56 cents a gallon. It's not a huge revenue source. It brings in about 6% of the T fund total, and we tax about 67 million gallons of diesel a year. So a penny yields about 670,000 of additional revenue. Gasoline, we tax just under 300 million gallons a year, which I should have mentioned on the last slide. So a penny on that yields a little less than 3 million of additional revenue. There are, of course, some exceptions to diesel as well. Off-road diesel, government use of diesel, things like that are not taxed. Slide 11, slide 10 gives you just a comparison of how we compare to other states in both our tax and diesel, and we're really right in the middle of the pack. We tend to be, pretty comparable, not only nationwide, but with our regional peers. Slide 11, the motor vehicle purchase and use tax. As you all know, this is a tax that's based on 6% of the taxable value of a motor vehicle purchase or initial registration. There is a cap of $2,075 for non-pleasure cars. So for big trucks over 11,000 or over 10,000 pounds, there's a cap there on what they pay. This tax is paid by DMV when you title or register your vehicle. You cannot avoid this tax by buying your vehicle in a state that doesn't have a sales tax on vehicles. We will give you credit for a tax that was paid to a state that has their own tax on vehicles. But if you didn't pay it somewhere else, we're going to ding you for it. They're really good at it. There's also a little piece in here as part of the purchase and use tax that is a 9% tax on the rental charges for short-term vehicle rentals in Vermont. So that sort of gets to the use part of the purchase and use tax. I don't think I've ever rented a car that had a license plate on it that matched the state I rented the car in. So this is a way of trying to recover revenue for the use of our roads from people renting vehicles in our state. There are some, the thing that you really know a lot about the purchase and use is statutorily since I think 2005, the total revenue has been split where 2/3 remains in the T fund and 1/3 goes to the Ed fund. There are some various statutory exceptions that I don't want to dwell on, but the one that's most notable is we do have a trade-in allowance. So you do not pay the tax based on the full sticker price of your vehicle. It's based on the sort of net cost of the transaction. So you get a trade-in allowance if you're trading in an existing vehicle. That way you're not taxing the same value of more than one time. And I mentioned earlier that, purchase and use has been growing like gangbusters and has reached historic highs during the pandemic. But, we need to see how this continues to shake out. Vehicle inventory constraints have been both, a constraint on vehicle sales, but also a symptom of just how strong the demand is, because lots are so empty because a lot of the cars that have been being delivered to dealerships have already been sold. So I bought a new car a few months ago, and I think my car landed on the dealer's lot 2 hours before I got there that day. Every other vehicle that had been trucked into that dealership was already sold several months previously. And we also need to pay attention to the economic conditions moving forward. Interest rates, the just broader economy overall, vehicle prices, the stimulus money winding its way through the economy could soften demand for vehicle purchases moving forward. So it's just sort of one of those known unknowns right now. Slide 12 touches on the last two big buckets. DMV fees, those are your driver's licenses and your vehicle registrations. They bring in about $87.8 million this year to the T fund, just under 30%. So that is a pretty significant revenue source. These fees are set by the legislature through fee bills, and the last time these fees were revised was for FY17. There is also that miscellaneous revenue that I mentioned earlier, and there's just a few examples there. That brings in a smaller share, $21 million, 7% of the T fund. Slide 13, where does all this state money go? This is the T fund operating statement for the two most recently closed fiscal years. You'll see that the vast majority of the money goes to VTrans, $282.2 million in FY22. But you'll also see an appropriation for the information centers that goes to BGS in the big bill. You'll see a reserve to meet the agency's Pay Act needs. You'll see a really small debt service line that's going to get smaller for the upcoming year. That pays GO bonded debt that related to transportation projects, but from several decades ago. This number is going to keep going down, and I think it finally gets paid off in fiscal 29. I think we have the T funds on the hook for less than $2 million of outstanding GO debt. And that 20.25 you'll see referred to as the JTOC appropriation that supports the state police. But you'll see here that, the vast majority of the money really does go to transportation purposes. The state really does not do a lot of diversion of it for other purposes. Slide 14, I'm just going to touch real quick on federal funds. The vast majority of our federal transportation funds come through a formula. And those formulas tend to have a lot of flexibility built into them, and we tend to benefit from those formula because they often feature small state minimums and often carry forward some legacy funding levels from decades ago when congressionally directed spending was a much bigger part of the funding equation than it is now. Vermont gets significantly more back from Washington than we send down to Washington in gas tax. Whenever we talk about federal transportation money, it typically comes in a multi-year surface transportation bill. So the last one was called the FAST Act, and the current one is featured in the Bipartisan Infrastructure Law, the IIJA. The IIJA provides a 5 federal fiscal year authorization, but states have a longer period of time to actually spend that money down. So that's why it's sometimes helpful to think not just in terms of like 1 year to 1 year to 1 year, but look at the total 5-year horizon to see what you're going to expect coming your way and what you need to plan to spend. One of the things that's really, really great about this bill for Vermont, and this kind of goes into the good problem to have kind of definition, is this new bill is expected to bring over $570 million more than the previous iteration under the FAST Act over the life of the bill. So that is roughly 50% increase in federal formula funds. And that's just the core highway funds. We also get funding from FTA for public transit, FAA for the airports, FRA for our railroads, but those are competitive grants. But the vast majority you see up here.
Yeah.
But as those federal funds increase, we will still need to match them, am I right?
You are right. Let's flip to slide 15.
Hey, all right.
So just yesterday, what day is it? Thursday? It was either yesterday or the day before that. I'm losing track. VTrans presented their latest projected funding gap to the two transportation committees. So last year when the infrastructure bill passed, I think we all realized that there was going to be some pressure coming where, we have a great opportunity to have all this additional money available, but we need to make sure we have the fiscal capacity to draw it down and maximize it. In FY22, about a year ago, VTrans expected a funding gap would begin to emerge starting in FY24, and that gap would be about $31 million. So that was based on their projection between what they think they would need to spend to do what they do and to also draw down the federal money according to their projected project timeline versus the revenue forecast. So that was sort of the gap between the alligator mouth. That is being proposed to be closed this year through essentially through a reversion back of unspent appropriations to the T fund of around $20 million and a one-time general fund transfer of just under $11 million. Yes, sir.
They 80/20s, the federal state match.
Most of them are. That's a good rule of thumb. The key exceptions are interstate work tends to be 90/10. Aviation grants tend to be 90/10. Rail, it depends on the terms of the grant. And there are often opportunities where you can have a higher federal share if you do certain things, or sometimes there are limited abilities to use like other federal dollars to meet the it is real complicated, but the general rule of thumb that folks tend to plan on is 80/20.
Okay.
But we just got this latest gap analysis and you see it posted here. And, they get close to closing that roughly 30 million this year through some one-time reversions and general fund transfers. But moving forward into FY25 and FY26, that gap is proposed to be closed by putting $68 million of general fund in reserve in the FY24 budget, and then transferring those dollars to the T fund in FY25 and FY26 to help them meet their match. So there is still a structural gap between T fund revenues and expected T fund expenditures, but the current proposal is to bridge that gap for the upcoming 3 state fiscal years, so 24 through 26, by using one-time general funds.
Yeah, so is that gap, you suppose that gap is going to resolve itself at some point in year 4 or something, or is this an ongoing problem that we're going to have to sort out?
If I had a crystal ball and could predict the future, I'd be a very wealthy person. But let's put it this way. Every time we've had a federal multi-year surface transportation bill, they've never given states less money than they did in the current bill.
Okay.
So I expect even after the life of the FAST Act, the IIJA, whatever the future iteration is, will likely have additional formula funds coming to it. There were some sort of one-time programs, or that might be one-time. We think they might be one-time. There's a new supplemental program for bridges and for EV charging along interstate highways. It's not clear whether those programs are going to continue beyond the life of this bill, but typically the feds do not give you less federal formula funds in the future. They give you more. Your costs tend to go up in the future, not only labor, but your commodities, the cost of building a bridge, things get older, the scope gets bigger. That is a long way of saying, I don't expect this to resolve itself.
Okay, and currently the plan is to use general fund dollars for Parkton.
That is the governor's recommend.
And so that trend, that happening may just continue at some point in time.
And assuming things pan out exactly as presented in the governor's recommend, there's still a question of what do we do after fiscal 26?
Okay, that's a good answer. Thank you.
Slide 16 just sums it all up for you. So some considerations, remember Vermont, we really greatly benefit from formula funds from the feds, and we can thank members of the congressional delegation of previous years for that. The work they did really, we reap those dividends to this day, but we really do struggle to generate enough of our non-federal match needed to do what we need to do and also draw down that federal money. We have a structural issue here where gasoline consumption is likely to is just going to keep declining and likely decline at a more rapid pace the further out we go. So what does the new paradigm look like for funding surface transportation under this user fee model? Every state is looking at this right now. The infrastructure bill actually has money to grant out to states to help think about what does this look like? What is the sort of road user charge, vehicle miles traveled? That is likely the model folks are going to go to. I expect you will hear a proposal this session from the administration on how to pilot an approach like this to get funding from vehicles that do not pay gas tax. But there's a lot of approaches that are out there. Some states have looked at what would it take to just repeal the gas tax completely and replace the revenue. A lot of states have taken a sort of yes and approach and keep taxing gasoline while it's part of the mix, but think about how you position yourself for the future and monetize the non-gas powered uses. So, sir.
Chris, how many of our neighboring states use annual fees that are not contingent on a price, on a purchase and sale? I'm thinking about excise taxes.
Yeah.
I think Massachusetts does.
Massachusetts.
And that provides more of a source that you can count on.
Yeah, Massachusetts does. A few states do this. I haven't done an inventory of all of our neighboring states who do it, but what Representative Anthony is referring to is a lot of states call it an ad valorem tax, where where you essentially pay an annual fee based on the value of your vehicle. So rather than just paying at the time of purchase and initial transaction, a lot of times these formulas sort of factor in the age of your vehicle, the value of it, depreciation. So, if you're driving a car that's 5 years old, you're going to pay less than you would if it was 1 year old. They can be kind of complicated. They can be controversial and not particularly popular because people don't like continuing to have to pay a tax on a vehicle that they may have bought but just continue to use. But it is an option that some states do use. So the other thing I just want to leave you with is we've got this funding gap that is projected, but also be mindful of inflation. It's a great opportunity that these additional funds could present, but we also need to be mindful of the fact that if inflation continues to persist at the levels it has been in recent years, we could buy a whole lot less work with those dollars. And every state is wrestling with this because you only have so much contractor capacity. The workforce only is so big. And when this bill passes and all this money sort of hits nationwide at the same time, all of your supply chains don't expand suddenly in response to it. So there's going to be some growing pains. There's going to be some inflationary issues to work through. But at the bottom, that's the cautionary note to say, it's great that we're getting all this money. It may not necessarily be a huge transformative windfall. And it does present some real challenges for us because we need to figure out how to draw it down. Last slide is just my contact information. If you have any questions, I know we've got like 3 minutes left, but it's a really big topic to try to breeze through, but I'm happy to dive into the weeds with anybody if they want to do so.
You actually have until 2:15.
Oh, really? Well, we can just hang out then.
Yes, please.
Just kind of going all the way back to slide 3 for a second, sorry.
Yeah.
Can you talk a little bit about the jump in the budget for the TIP fund by 23? Like, I think one of the things I heard you say was that you try not to have a lot of debt, so
Right.
how is that financed?
So the TIB fund, when we don't have bonds outstanding, you will see these TIB funds reflected in the agency's budget, used as if they were T funds. So they're not quite as flexible as T funds. There is a rule that you can only use the TIB funds on a pay-go basis on hard infrastructure projects that have a remaining useful life of at least 10 years. So you will see that, $19.8 million in FY23 will be spent in the program development section of the budget typically and on bridge work. So that will support a lot of the town highway bridges and also the interstate and state highway bridge and roadway programs. That jump you see from 22 to 23 is a function of gas prices going up.
Thank you.
Anyone else? Feel sad that Representative Matos isn't here because I know that this is a topic that he's particularly interested in. Thank you.
No problem.
Much, really appreciate it.
Happy.
Thanks for the history lesson. Thanks for the history lesson in the middle there. Did it?
Yeah, it was an interesting week or two. And the basic emphasis is how can we get the governor to commit to spending more on transportation when it's falling apart? And so, anyway, there's more sort of scuttlebutt, but that's the basics of it,
So we're going to take a break till 2:15 when we will talk about reappraisals, which is
Cool.
everyone's